Hi and welcome. In the previous video, we talked about the importance of checking a company's report before buying its stock. Not just the charts or headlines, but what the company itself says about its current situation and future plans. Sometimes you find a company that's growing fast with strong numbers and a clear strategy. But even then, there is one more question you have to ask. What is the price? Because even a great business can be a bad investment. If you pay too much, it's like buying a car. Let's say it's a brand new, powerful, efficient, everything you need. But if the dealer asks for $1 million, would you still buy it? I doubt. Same with the stocks. The business might be great, but the price has to make sense as well. So, here is how I look at investing. For me, there are two key parts. First, choosing the right company, and the second, finding the right time to buy it. And honestly, I think the second part is where many people lose their money. Even a great company can turn into a painful investment if you buy it at the wrong moment. Let's say we've found a company with solid fundamentals and a great potential. I don't just jump in. I wait. I watch the market because sometimes the whole market or a specific industry or sector goes through a correction. Maybe there is a fear or bad news or just a wave of pessimism. That's when the prices drop. And that's when people stop paying attention. And that's usually when I start building a position, slowly and carefully. When good companies go on sale, I want to be there. Now, with ETFs, it's a different game. You can use a passive strategy like dollar cost averaging or DCA. Just buy regularly, no matter what market is doing. That works when you are investing in the whole market because the risks are spread out. But when you are buying individual companies, the risks are higher. And because of that, the timing matters much more. Markets move in cycles. A company can be overvalued or undervalued depending on where we are in that cycle. And that's why I try to buy during those undervalued periods. Not because I'm trying to perfectly time the bottom, but because I don't want to overpay for something I believe in. Now, how do I know if something is expensive or cheap? Over time, I've built a kind of market awareness. I've watched certain companies long enough to recognize patterns. I see how they react to global news, to earnings reports, to industry shifts. I notice when the price feels out of the reality. And that kind of experience helps. But I also rely on numbers. One of the key metrics I use is price to earnings ratio, the so called PE. It basically shows how many years it would take for the company to pay for itself based on its current earnings, if those earnings stay the same. I usually look at the company's historical average PE, what's been considered normal in the past. Then I compare it with the current PE, both trailing and forward. It's also important to remember PE ratios vary a lot from industry to industry. A ratio of 25 might be totally normal for a fast growing tech company, but extremely high for, say, an insurance business. That's why I focus more on how today's number compares to the company's own history, not just to some general rule. Let me show you what I mean. I'll open up one of the company's profile on the GuruFocus. This is one of the tools that I often use. You've seen it in the previous videos. And Here we can easily find the price to earnings ratio, both the current one and the forward estimate. And what's even more important, we can see how this ratio has changed over time. Let's go first. I'll show you with the example of Nvidia Corporation. We scroll down. Here is the price to earnings ratio, 50.7, which seems a lot. Forward price to earnings ratio, 36.5. If we go to the different source, which is often used by the investors, traders, etc., TradingView, and this is the Nvidia's chart, starts from 2018 up to today. So the price chart for the stock, yeah, it went up quite high, 3,900% gain since what is that, 8 years ago. Okay, and another trend here is the price to earnings ratio. You can see it here. So now, as we read, it was 50.7, right? And now the average for the company is, let's say, 66.70, and the company is even being at the top now, the chart being on the top, on the high level, it's still showing the forward ratio of 36, which seems to me a bit even low. That way, you don't just look at a number, you see the trend. Is the company trading above its historical average, or maybe it's currently undervalued compared to its own past? For me, it's always about timing and value. A great company can still be a bad investment if you pay too much for it. That's why sometimes you just need to wait before investing. And that's why this approach requires your attention, effort, and your patience, which is sometimes too boring, to be honest. That's it for today. Thanks for watching. Please hit that like button, subscribe to my channel if you want, and see you in the next video. I appreciate it. Thanks.